All right, I believe we are live. Let me just check the sound. Are we live? We are live. Okay. I think the sound seems okay. Make sure I have everything in the right place. Testing, testing. If y'all can see this, I use a sippy cup because the cats will dip their paws in my water cup. They do that consistently, so this is what I got to do now. Sippy cup. Okay. Because I know you guys were curious what the deal is with the sippy cup. Okay. All right, a couple companies I want to go over today. Amazon, for one. We got earnings coming out tomorrow. Is it pre-market? Let me see. Let me remind myself. After hours tomorrow. Okay, so there's time. I want to go over Amazon, and I want to look at Meta a little bit because their earnings report did come out, and they have been dropping quite a bit after hours. Just a little sneak preview here. Let's look at Meta. Down 7.5% nearly. For people who are watching, if you could please comment on the sound, just make sure everything sounds okay. On my end, everything seems to be going all right, but let's start with Amazon. All right. Hey, Hokage, how's it going, man? Okay, sounds good. Glad to hear it. I'm glad you could make it today. I'm always happy to see you in the chat, buddy. All right, let's get going on this. Hokage, I know you're familiar with my Mag 7 video that came out recently. I wanted to touch on Amazon again for this live stream, and I wanted to look a little bit at Meta because their share price has dropped a lot. And so I wanted to go over their earnings report live on stream. I haven't looked at it. I wanted to react to it live, so we could go through that process together. Anyway, Amazon. So this article dropped recently where Amazon's plot to replace 600,000 workers with a robot army has been circulating online quite a bit. They claim that they will save 30 cents per package. Where did I see it? It's in this article here. Amazon expects robots will help it save 30 cents on each product for a total of $12.6 billion in labor costs between 2025 and 2027 due to automation, replacing jobs. So Amazon has been spending tons and tons of money on investing capital. And this is the main point of disagreement between my opinion on Amazon and some of the comments that I've been receiving recently on my latest valuation of Amazon. And after doing some more research, I think I tend to agree with the comments. I don't think I was giving Amazon a fair shake in terms of their capital expenditures, because a huge portion of their capital expenditures, and this is an example here, if they're right, this is going to go towards increasing the efficiency of their business. It's going to go towards making meaningful additional free cash flow in the future. So I think I want to revisit Amazon, specifically how I'm going to divide growth capital expenditures and maintenance capital expenditures, because whenever I'm doing my pricing models, I like to look at free cash flow. Free cash flow is the chunk of money that a company reinvests to give me a return as a shareholder, whether that's reinvesting through stock buybacks, acquisitions and mergers, or organic growth, like in Amazon's case. Or maybe they're going to pay a dividend and put cash directly in my hand. Free cash flow is the sum of money that they use to do that. So free cash flow is, on the surface, it's calculated as taking the operating cash flow and then subtracting all capital expenditures. But in the case of Amazon, it's not so simple, because they are spending lots of money in their capital expenditures section on their cash flow statement that's going towards growth. So Hokage, Google earnings was good today. It's up 5% after hours. Yes, I saw that. I have not dived into Google specifically to see, what I think of their earnings, but I did see that their share price was going up. So that's good for me. Good for you. I believe you also invested in Google. So yeah, happy to see that. I think Google is a great company. But let's look at Amazon. I want to see, I guess the question I'm trying to answer in this live stream is, do I want to invest in Amazon before earnings? The earnings is coming out after hours. Generally speaking, I like to wait so I can have the freshest information on the table, so I can make a decision based on the most recent, most accurate information. Because if I'm investing pre-earnings report, yes, I have the chance to make a lot of money if new information comes out that looks really good and Amazon's share price shoots up. I have a chance to benefit. But if new information comes out and it doesn't look good, so I don't want to leave it up to luck for the most part. So, but in saying that, I want to look again at Amazon's free cash flow valuation, taking into account more accurately their capital expenditures. So let's pull up their financials really quick. I want to look at this. So if we go to the cash flow statement, like I said, free cash flow is calculated by taking the operating cash flow and subtracting capital expenditures. Now, I make a lot of adjustments to that beyond capital expenditures, and I believe on my previous video where I did evaluation on Amazon and all of the Magnificent Seven, I think I used a conservative 90-10 breakdown, where I assume 90% is going towards maintenance, 10% towards growth. I tend to default to a very conservative breakdown on capital expenditures just to be cautious, because when a company is very heavy in capital expenditures, and we can see that Amazon is very heavy. Look at this. In what year is this? This is 2021. They made they cash flowed $46 billion from their operations, and they turned around and spent $61 billion on CapEx in 2021. More recently, they spent $107 billion on capital expenditures. Excuse me. Now, when a company is very capital intensive, this is not a good thing in my book. I don't want to see a company be required to spend a ton of money on their CapEx just to maintain their current competition, or just to maintain their current operating cash flow. If they have to spend a lot just to maintain what they're doing, I don't like to see that. On the other hand, I want to see if Amazon is going to be able to scale back their capital expenditures in the future, because if these are big investments that they're going to be able to cash flow on in the future, at some point, companies tend to level off on their capital expenditures. Like, you can only grow so much. Eventually, you have your entire addressable market that you can possibly take advantage of to cash flow. At some point, you have to scale back and just maintain what you have. And so the case is that Amazon is still growing quite a bit. And I want to see if I discounted them in their capital expenditures, basically. So one assumption that you can make as a shortcut, if you don't want to do the research, if you don't have time to do a bunch of research, a lot of people will take the depreciation. This sum of money right here. This is a non-cash expense. This is how much Amazon's current capital assets lost value on paper. A lot of people will take this amount and use it as a proxy for their maintenance capital expenditures. So in this case, $57 billion as a percentage of 107. That's a high, that's a little over half. It's about half. It's about 50%, sorry. That's about 50% of their capital expenditures going towards maintenance, if I'm going to believe depreciation and amortization. And over time, as a company becomes mature and they're no longer able to really grow, you're going to see depreciation eventually equal capital expenditures. That happens over time. So in general, this is a decent approximation of a company's maintenance capital expenditures, but it's by no means exact. So in a little bit, I'm going to go into the most recent annual report to see, does Amazon give any clues as to what their maintenance capex could be versus their growth capex. Another thing that I will adjust free cash flow on is stock-based compensation. And I think a lot of people don't do this, and it does make a big difference. So here we can see that stock-based compensation, this is a non-cash expense. So Amazon is paying their employees with stock and not cash. So you take on the cash flow statement, you start with net income, and then you add to that net income the non-cash expenses that aren't actually reducing a company's cash flow. So depreciation, this is just losses on paper. It's not really cash leaving the company. So they add this back in, they add back in asset restructuring and write-downs, they add back in stock-based compensation because it's not cash actually leaving the business. However, if we scroll down a bit and we see, where is it? Repurchase of common stock. So in this case, they're actually not even repurchasing stock. So this stock-based compensation, this is diluting current shareholders, not by a ton, but it is diluting current shareholders. And so I like to reduce free cash flow by this stock-based compensation because most companies will eventually start buying back company stock. And so, they pay out in cash, but then they end up buying it back, they pay out in shares. They end up buying it back. So they still end up spending that cash. So I reduce the free cash flow by 90% of the stock-based compensation. I don't do 100% because I think stock-based compensation is better than just paying in cash because it aligns a company's employees with the stock going up, right? So obviously if you have stock-based compensation, you're more incentivized to get the stock price to go up. I think it's a good thing overall and over cash. So I don't reduce free cash flow by 100% of stock-based compensation for that reason. I will also reduce free cash flow by 10% of cash acquisitions. Now this, I don't know. I don't have a really precise reason for saying 10%. Maybe it would be good to do 5% or 20%. But in general, for cash acquisitions, I see it somewhat as a capital expenditure. And a lot of times when you acquire a business, you have to buy it at a premium, so I try to account for that. I try to reduce free cash flow a little bit by capital expenditures. And there's some arguments to be made that maybe if the cash acquisitions are synergizing really well with Amazon, then you wouldn't want to punish them for that. Getting a phone call. Sorry, 1 second. I got it. Anyway, okay. Sorry for the interruption there. Where was I? Cash acquisitions. You could argue that if they synergize incredibly well with the business, you wouldn't want to punish them for that. That may be the case. This is a really small number in the scheme of things. So reducing their free cash flow by 10%, it's not going to move the needle a ton. But in general, I like to stay pretty conservative with my free cash flow valuation. I want to set up a scenario where the company is likely to exceed my valuation. That way I can feel confident that if my valuation looks good, it is likely to be surpassed. That's how I kind of base my investment strategy. So now that we've seen the things that I'm adjusting my free cash flow by, in the video, I gave Amazon credit for an additional 2.4% free cash flow margin. If we go to their free cash flow margin history, I think in the video I gave them credit for 10% of their capital expenditures. So we got R&D. I give credit for a percentage of R&D because in my mind, some percentage is going to go towards creating new products that are going to make more money for the company in the future. Now, some companies are very reliant on R&D, and they have to continue innovating again and again in order to keep their customers. Like, for instance, Apple, they have to continually make new iPhones. If they do not spend a lot of money on R&D, then they're going to start losing market share. So, I have a hard time giving credit for more than 10% of R&D, because a lot of times it is just a requirement for a company to stay in the game. So I give 10% of R&D credit into free cash flow. I think I gave 10%. Yes, I gave 10% for CapEx. I gave 10%, or I took away 10% for cash acquisitions, and I counted 90% against stock-based compensation. And then I used their most recent, based on those adjustments, their most recent free cash flow margin. So 2.4 plus 2.1, that gives me my 4.6. I assume 10% revenue growth in the next 5 years, followed by 5% revenue growth in years 6 through 10. I decided to use half of years 1 through 5, and this is the analyst consensus projections for revenue growth over the next 10 years. And then a growth rate of 3%. This is a perpetual growth rate. Where do I get a 3% perpetual growth rate? Why do I need to account for that? Well, Amazon isn't just going to go out of business after 10 years. This is where I have my projection period. They're going to continue business in the future. They're going to be, by my estimation, a mature company in 10 years. Now, of course, a lot can change. That's just the assumption for this valuation. I use 3% because it's somewhere between GDP growth and inflation. So inflation, generally 2 to 3%. GDP growth, close to 4%. Let's see, what is inflation, GDP over the last 50 years? I believe I looked it up in this link. Where did they say that? Forecast. Okay. Growth rate, GDP annual growth rate in the United States averaged 3.15% from 1994 to 2025. So going with a perpetual growth rate of 3%, it definitely should not exceed GDP, because if I go with a perpetual growth rate of a number that is more than GDP, then eventually Amazon would dwarf the entire US economy. So obviously that can't happen. It has to be less than GDP. This could be a little bit aggressive, but I'm going to stick with 3%. Now, given those assumptions, with a desired return of 8.14% per year, so that's my desired return. Based on these assumptions, Amazon is overvalued. This is my projection. This is using the 10% over years 1 through 5, 5% for years 6 through 10, and then 3% going forward. Fair share price of 73. Now, that's 68% overvalued. I did paste in the analyst projections for their future revenue, and I get that from stockanalysis.com. If I go to the forecast tab, by the way, the analysts mostly like Amazon. 22 analysts give a strong buy rating, 24 give a buy rating. So if I scroll down to the analyst consensus for revenue growth, I've pasted these percentages. So the highest analysts are saying about 17% revenue growth every year for the next 5 years. The average analysts are saying about 10%. The lowest analysts are saying anywhere from 6 to 1%. So after pasting those values, I have a range of fair share price still showing overvalue. Now, if I give credit to Amazon for 50%, which is based on their depreciation, if I use depreciation as my proxy for Amazon's maintenance capital expenditure, then this brings their most recent margin up to 9.8. So if I now give Amazon credit for 9.8, that means I need to add 6.6. Now they're approaching closer to fair value. The average analyst consensus still puts it at 35% overvalued. However, when I go to Amazon's most recent annual report, and I read here, oh, I lost my light. 1 second. Well, technical difficulties. We ran out of batteries. I just won't be as illuminated today. Alrighty. if we look at this sentence right here, cash capital expenditures were 77.7 billion for 2024, which primarily reflects investments in technology and infrastructure, the majority of which is to support AWS business growth. So Amazon is saying that the primary focus of their capital expenditure goes into technology infrastructure, going towards AWS business growth. Now, when I go to Amazon's, let's look at their forecast right here, financials, cash flow statement, CapEx. So that was their cash capital acquisitions. It's a little bit less than their total capital expenditures. Sorry, not capital acquisitions. It's a little bit less than their total CapEx at $83 billion. So what I'm going to do is I'm going to take them at their word. I'm going to say the majority of their CapEx should go towards growth. So I'm going to exceed the 50% that shows for depreciation. I'm going to bump it up to 60% of their capital expenditures. Now their average free cash flow margin over the last 5 years goes up to 7.4. Their most recent free cash flow margin bumps up to 11%. So we're going to adjust accordingly. I'm going to now bump it up to 8.8, giving an 8.8 boost to their past free cash flow margin because of the credit for capital expenditures. Now the average analyst puts them at 18% downside and a 9% upside for the highest analyst projections. So if they exceed the highest analyst projections, then at that point Amazon would be slightly undervalued currently. So given this new set of assumptions, it's not as egregious as before, but Amazon still looks to be a little bit overvalued based on this assumption right here. Now, if we further take into account that Amazon will be more profitable going into the future, then that would mean a growing free cash flow margin going forward, which I can also account for. Now, I also want to bring up the Morningstar equity analyst report for Amazon. I love looking at this analyst report. They give lots of good information here. If I scroll down to the bottom, they also give some really good projections, and they tend to align with the analyst consensus. I've noticed they tend to. So let me just scroll down a bit. There's a table. Okay, here we go. Revenue growth over the previous 3 years, 10.7%. Over the next 5 years, according to Morningstar, they are quoting a 9.8% revenue growth going forward. Now, in terms of profitability, free cash flow to the firm, they're quoting 11.7%. And we can see that in 2025, so they quoted that they would be spending a lot more on capital expenditures, but Morningstar is showing a growing profitability, 6.5 to 13.3, 13.1, 12.9, 12.6. So Morningstar is saying that they're going to be more profitable going forward. So if I build in some growing profitability, I do that right here with free cash flow margin growth. Let's say over the next 5 years, they're able to increase their free cash flow margin by 1/3%. So that gets me nearly an extra 2% over the next 5 years. Now they're getting closer to fair value. And then if I additionally give them some more credit, let's say after 5 years, they have their 10% revenue growth on average for year 6 through 10. Let's say they don't slow down. Let's say they're still able to maintain 10% revenue growth as well as an aggressive perpetual growth rate of 3%. And just to give you a quick look at the sensitivity to this number, because this perpetual growth rate does make a big difference in terms of valuation. So if I drop it to say 2%, then this average analyst rating, it just showed 13% undervalued. Now it shows 1% overvalued. So just adding 1% to the perpetual growth rate makes a huge difference. But this is what it takes. So it takes growing profitability. It takes good investments into capital expenditures. So all these capital expenditures, billions, hundreds of billions of dollars that Amazon has funneled into CapEx, it all has to work out well. It has to be a good investment. It has to contribute to growing their free cash flow in the future. They have to have growing profitability. They have to maintain 10% revenue growth for the next 10 years. And then at that point, Amazon looks to be slightly undervalued. If I go with the highest analyst expectations, then we're seeing a little bit of a bigger upside. But I guess my point in showing this is, yes, I was too harsh on Amazon in my initial valuation, but I still personally am not going to be investing in Amazon ahead of this earnings report. And if it turns out that they crush this earnings report and I missed out on an opportunity to invest in this company, I am much happier missing an opportunity than being hasty and investing in a company that I'm just not like super convicted on, super high conviction, and then losing money. That is the thing that I'm 100% trying to avoid. That's why I always err on the side of caution, and I use the most conservative version of a free cash flow valuation that I can, so that I can be just extra sure that, I shouldn't say sure that I won't lose money, but I want to set up a scenario where the story where I lose money is just the least likely thing to happen. It's going to happen. I try to stay pretty diversified with my investments on this YouTube public portfolio. There has been misses. There will be misses in the future. So personally, I'm going to be waiting on Amazon to come out with their next earnings report after hours tomorrow before I go to invest, because given the situation that I'm seeing now, it just doesn't look as decisive as it would need to be for me to invest ahead of that big. It's a big information drop that's about to happen. Like, I want to invest with the most up-to-date, most recent information available. Otherwise, I feel like I'm leaving it up to chance. It feels more like a gamble to me. So those are my thoughts on Amazon. Next, I want to look at Meta, because Meta dropped off their share price quite a bit. And I want to see, does it make sense to jump into Meta after this particular earnings report where they have dropped over 7% after hours? Let me pull that up again. 7.5% drop after hours, $55 their share price has dropped. And if I just look at how far back do we have to go to see a share price of $700 per share, if I look back a month, they haven't been that low. It looks like we'd have to go back to July. So back in July, this is where they were in July. Man, I wish I would have been paying attention to Meta when it dropped down below $500 per share, but you can't catch them all. You can only focus on so many companies. So let's check out Meta. So in order to see their latest report, I like to just Google Meta Investor Relations. Okay, and we're doing this live. I have not looked into this earnings report. This is my live reaction here. So, quarter over quarter, Meta increased their revenue by 26%. I mean, that's huge. Let's see, what's the analyst expectations for growth on an annual basis? Let's see. The analysts expect a 22% revenue growth on average for 2025. So this quarterly growth is really strong with that in mind. So 26% revenue growth. Their costs and expenses did increase by 32%. So their expenses increased by more than their revenue in terms of percentage. However, their income from operations did increase by 18%. Provision for income taxes. Now, this was a little bit spoiled for me. I saw some stuff online that said there is a massive one-time expense for Amazon in the form of a provision for income tax. So their net income took a massive dip. And I believe that is why the market has reacted so poorly to Meta, because I mean, look, their net income quarter over, like 1 year later, I think I said quarter over quarter before. This is comparing this quarter to a year ago, a quarter. So if I misspoke there, I apologize. So their net income dropped by 83%. That is a huge drop in net income. Now, this is a one-time expense. So this doesn't necessarily hurt their free cash flow going forward, other than like whatever opportunity costs we're missing out on. So we're going to look to try to take this into account when we do our model again here shortly. So provision for income taxes, one-time non-cash charge impact. We expect a significant reduction in our U.S. federal cash tax payments for the remainder of 2025 and future years due to the implementation of the One Big Beautiful Bill Act. However, the implementation also led to the recognition of a valuation allowance against our U.S. federal deferred tax assets, reflecting the impact of the U.S. corporate alternative minimum tax. As a result, the third quarter 2025 provision for income taxes includes a one-time non-cash income tax charge of $16 billion. Excluding this one-time tax, our third quarter would be the following. Net income would be net income would have increased by 15.9 billion to 18.64. So it would be 15 going up to 18. That is a $3 billion increase on net income without that one-time fee. So that is about a 30% increase roughly. So without the one-time fee, Meta's looking pretty strong. So how do we take this into account? Let's see here. Oh, and CFO Outlook commentary. I'm not going to read through all this on stream. I really just want to see how this affects my model valuation of Meta. So let's go ahead and do that. Okay. This is an automated spreadsheet. I've automated as much as I can, so I can just plug in the ticker and then it's going to do a lot of things automatically. Let me drop this down to 0. I'm going to kind of go back on some of these things. And then I've also pulled up Meta analyst report by Morningstar. So just really quick, they're showing 3-star rating. So they are roughly fairly valued. Or slightly undervalued, we'll say, according to Morningstar Equity Analyst Report. And what's the date on this report? This report was updated on July. Is that right? August. Report as of August 1st. So this is a slightly outdated report, but let's see what the analyst let's see what the analyst predictions are nonetheless. Margins and returns. So they don't even give, revenue growth. Here we go. Over the last 3 years, 11%, 5-year, 13.6%. Free cash flow margin to the firm. It looks like in 2024, their margin was quite high. It looks like they're projecting to be significantly lower than 2024. So we had a peak year in 2024. Should be lower going forward, so maybe closer to the average. Their 3-year average is 15%. They're projecting their 5-year average free cash flow margin to the firm to be 12%. So we need to take that into account as well. But first, let's just pull up, the analyst expectations here. Really strong revenue growth if the average analyst is correct. That looks really good. And it is, once again, the average is about in line. It looks like they're projected to do a lot better in the year 2025 than the average analyst projection or the Morningstar analyst projection. But anyway, we're going to copy this, paste those values into the spreadsheet. And as far as the average growth for my own personal projection, I'm going to throw 14% in there. We'll say over the next 5 years, we'll go with 10 and then a 3% revenue growth going forward. Okay, this is pretty close to in line with what we had projected earlier. Now, I do need to double check right here. So this is the big question. How do we handle Meta's capital expenditures? So let's go to Meta really quick. Let's look at their cash flow statement and see how does their capital expenditure compare. And once again, a hefty stock-based compensation. So I do punish them, or I shouldn't say punish. I reduce their free cash flow by 90% of the stock-based compensation. CapEx, a lower percentage of the operating cash flow than Amazon. Compared to depreciation, So if we're going to use depreciation as the percentage of, if we're going to use, the percentage of maintenance CapEx, it looks like this is a little bit less than 30%. So I think I do make that calculation on here. Yeah. So we're going to say if we give Meta credit for 60% of their capital expenditures, if we give them credit for 60%, and then we take into account that this would give them a free cash flow margin of 40%, which is huge. However, in 2024, that was a peak year for them, and their free cash flow margin is expected to fall more in line with their average over the last 5 years. I would still be giving them credit for a 35% free cash flow margin, which is significantly higher, I believe. I think it's like quite a bit higher than what I anticipated initially when I did the first, this needs to be 6.5, when I did my initial evaluation. So if we take these assumptions to be true, that Amazon will, on average, grow their revenue by 14% per year for the next 5 years, and then 10%. They're going to drop down a bit for years 6 through 10, a perpetual growth rate of 3%, and their capital expenditures do give them quite a bit of return. Then they are undervalued at this time. Their fair share price, according to this valuation, would be $955, representing a 27% upside. So Meta is a great company. If I can buy Meta at a fair value, given new information is current and accurate, and they're undervalued, it's hard to pass up on this company with this new valuation in mind. Morningstar also gives them a wide moat rating, which means that they are likely to have excess returns going forward for a long time. Over the next decade, I believe, is Morningstar's criteria here. They believe that Meta will have really good growth over the next 10 years and margins. So a company that has a wide moat and appears to be undervalued is a really tempting investment. So now, how aggressive are these assumptions? One exercise I like to do is I like to reduce the story until I hit a 0% upside. That tells me what the market is currently pricing Meta at. Like this is the story that the market believes going forward. So if we reduce the free cash flow margin by a bit, drop it down to 13%, and if I reduce the the revenue growth down a bit to 10%, this is the average. This is actually adjusting my projection. So if instead of 14%, if they just hit 10% going forward, then it looks like Meta is just a bit overvalued. $694. Yeah. Oh wait, no. I think actually stock analysis is taking into account not the after hours share price. So let me see something really quick. We get it to 0. Yeah. So actually, we are not taking into account the after hour share price, which is, just a reminder, $696. So with that in mind, if I drop this down to 3, $696. So this is what the market believes about Meta. A free cash flow margin of 31%, revenue growth of 10% for the next 10 years, perpetual growth rate of 3%, and a discount rate, which is my desired return over the next, we'll say 5-year investment period, 8% return, or it should converge on an 8% return per year every year. This is what the market thinks Meta is priced at. To me, given that the average analyst projections going forward, the consensus is higher than this, and Meta likely should have more credit for their free cash flow margin, I would say Meta is currently undervalued. And I plan to invest $100 this week into Meta. Every week, This is my public YouTube portfolio series. I like to put $100. I will pull up the portfolio now so we can see. I believe I have 36 holdings. We are currently, unless things have changed recently, we are currently beating the market. Maybe I shouldn't say that before I confirm. I don't want to put my foot in my mouth, because the market is moving a lot lately. Bear with me while I pull this up. Okay. All right, here is the portfolio. We've been investing about $100 per week. Some weeks a little bit more, some weeks a little bit less. Or actually, I don't think we've done less any week. I think some weeks we'll do a bit more, depending on, just what's going on in the market. So, okay. These are the holdings, and the screen is scrunched. I apologize for that, but let's see, how can I do this to show this a little bit better? Okay, we're just going to cover my face up for a minute. I apologize. I know you guys hate to lose that, but okay. Here's the portfolio. We got HIMS on top, ASML. Google has been performing really well. Really happy with Google's performance. Universal Health Services, UNH, British American Tobacco, HCA, Genmab. And then as we scroll down to some of the holdings in the red, we've got Adobe in the red, Realty Income Corp, and Doc. These are two REITs that I invested in last week. They are currently down. I believe these two are good recession-proof investments, solid dividend, and they are in sectors that are resistant to recession. So this was on a previous live stream. If you're interested, you could go back and find those. It's the recession-proof live stream. Crocs is one of my more, we'll say, high conviction companies. It's currently down. I believe this one is pretty undervalued. I have tripled down on this one. And then at the very bottom, we got Simply Good Foods, which is my current worst holding. However, the way I decide if I'm going to sell out on a holding is I will perform the discounted free cash flow calculation. And if it still looks good, then I keep holding. And that is the case with these companies. So I'm not prepared to sell these yet, even though they're doing so horribly. They still appear to be undervalued based on their discounted future free cash flow. So once that story changed, once new information comes out that leads me to believe that they are not coming back, only then would I sell out of those companies. So let's look at the benchmarks here. Oh, we are getting close to being on par with VT, Vanguard Total World. It looks like we're just barely edging out Vanguard Total World. Let's look at the SPY. Let's see, S&P 500. We are still beating S&P 500, 18% up year to date. We're still up 22.26. So for now, still on top. I'm going to keep watching that closely. The goal is to beat the S&P 500 over the long term. And with a stock picking portfolio, you can see that there is quite a bit of volatility. So there will be times, I'm sure, where we dip down below and hopefully rise back above. So we'll be watching that closely. Alrighty. Hokage, what is Doc? I don't remember viewing that one on stream. So that is a real estate investment trust that specializes in outpatient real estate. So they lease buildings to outpatient physician groups, and there has been a trend where the medical volume has been going from inpatient to outpatient, and there is also some political tailwinds for outpatient. Trump is looking to remove, I'm trying to remember the acronym. Trump is looking to remove the inpatient only list, IPO list, where this list basically says Medicare will only reimburse the healthcare provider if they do the procedure inpatient as opposed to outpatient. So he's looking to remove that list. There's over 1,000 procedures that were required to be inpatient. If it goes away, there's going to be a lot more volume going into outpatient. So I like Doc because I think it's got a structural tailwind in that people are naturally going to outpatient. These guys specialize in outpatient, so there's more demand for that kind of real estate, political tailwinds, and in the event of a recession, people still need to spend money on healthcare. So I see their leases as a little bit safer because those businesses should still get plenty of demand. And even if demand drops a little bit for the people that are leasing those businesses, as long as Doc is still getting their rent payments and those rent payments are scheduled to go up by 2 to 3% every year, then they're still going to have a growing source of income. So that's why I like Doc. And that was on a previous live stream. I can't remember offhand what it was titled. I believe it was a recession live stream. I'll pull it up really quick. Oops. My videos. We talked about that one on high dividend stock is recession. This high dividend stock is recession proof. And I actually looked at two companies. It was Doc and real estate or Realty Income Trust. So anyway, that is all we got for today. I just wanted to do a rehash on Amazon and Meta. Amazon, I still want to wait. I think it still looks like it could be slightly overvalued. More information may come out on this earnings report that leads me to believe otherwise, but for now, I think it's a bit too risky. Meta, on the other hand, I think this drop is a bit overblown. It's a one-time expense. And we can see, I also wanted to showcase what a big one-time expense actually does to, I just realized I didn't actually account for that. So provision is $19 billion. So how do we account for a $19 billion one-time hit? So let's see here. Here's where I do my calculation. Right here is where it takes into account how much cash they have. So I'm going to edit this spreadsheet just really quick. I'm going to temporarily delete my formula that I have in there. So I want to reduce it by 19. We'll just reduce it by, we'll reduce it by 19. So that would make it 35 billion. 500 million. So let's make this change. Oh, and before I make the change, let's just make sure I'm remembering. We're going to look at the average here. Okay. So average analyst projection, just so we don't forget, I'm just going to paste it right here for now. Okay. So this is what it was. After I make this change, we'll see how much it drops for a one-time cash hit. 19 billion takes me to 35500 roughly. After we make that change, that's the dashboard. Okay, so my fair share price dropped by a whopping $3.50. Still a 14% upside. So one-time cash hits like that, a cash hit of that magnitude is a drop in the bucket for fair share price, according to this model. This doesn't take into account opportunity cost. Maybe investors had high hopes for that $19 billion. Maybe there's a significant opportunity cost. I'm not going to speak to that, but a one-time cash hit, ignoring opportunity cost, is a drop in the bucket. So I think it's overblown. I don't think Meta deserves the 7% drop that it received. And yeah, I think it looks like a solid investment given it has a wide moat. It's probably pretty close to fair value, has a significant potential upside, and a relatively high downside, but I don't think the analyst low is a very likely situation. I think the average analyst opinion is quite likely. So there we go. That's what I'm looking at for Meta. Hope you guys enjoyed the stream. If you have any companies that you want me to look at for the next stream, I stream every Wednesday at 7:30 p.m. So if you have any companies you want to look at, make sure you come prepared and let me know the companies you want to check out. We can look at them live on stream. I don't have time to do that on this stream, unfortunately. I have to prepare because I'm going out of town this weekend for a wedding. So got to do that. Got to get packed. So I will see you guys next time. Thanks for tuning in. Hokage, if you're still around, I'll catch you next time.